things are still pretty good in Canada. We had extremely strong growth last year, 3%. We anticipate growth of about 2% this year. A significant slowdown, but it's a slowdown to a rate which is still inflationary, still above our long-run capacity to grow without inflation. So that means inflationary pressures remain and are on the rise. We've seen inflation essentially at the Bank of Canada's target, despite the fact that there's uncertainty, despite the fact that there are trade-related concerns, despite the fact that firms are holding back on spending because of NAFTA and because of uncertainty related to that. So we think the Bank of Canada's got quite a bit of tightening left to do. 125 basis points of additional tightening. The thing to keep in mind about interest rate increases by the Bank of Canada is that they are doing this because things are good. They need to slow the economy. The governor of the bank doesn't want to raise interest rates to make everybody's life more difficult. He's doing that because he's got to control inflation, and he's doing that because he wants things to slow. The U.S. is going through a period of exceptionally strong growth. There's no question about that. Private domestic demand is rising pretty significantly, so investment's strong, consumption's strong, residential activity is pretty strong. So by and large, the base on which the U.S. economy is operating at very strong levels. In addition to this kind of fundamental demand, you've got fiscal policy in the U.S., which is kind of turbocharging growth, adding a third to half a percentage point of growth this year. So you're looking at growth in the U.S. around 2.8%. It's extremely strong growth. We don't think that's going to last. We expect a reasonable slowing next year, somewhere in the 2.3% range. So significant slowing, if you will, from 2018 to 2019. That builds in some of this uncertainty related to trade. But fundamentally, you've got an extremely strong U.S. economy where inflation pressures are reasonably significant, so the Fed has to act. We anticipate 3 rate increases this year, 2 more next year, so rates at 3% by the end of 2019. Reasonably gradual pace of increase, reasonably low kind of terminal rates in the U.S., so 3%. So nothing particularly dramatic, but the Fed does need to tighten monetary conditions to slow growth and to keep inflation in check.